Hi, welcome to day 11 of You Can Become a Master Series 1. Today we will be discussing about equities, equity trading, stock exchanges like New York Stock Exchange, National Stock Exchange, Bombay Stock Exchange, European stock exchanges, and also the concepts of Nifty and Sensex. As we are discussing derivatives, I will not spend time on equity except mentioning that equity shares represent ownership in companies where investors benefit from growth as well as facing the risk of losing investment when the conditions go bad. Equity investors have voting rights in the company. We also have preference shares which earn dividends, but preference shareholders do not have voting rights in the company. Equity shares can be bought and sold through stock exchanges or over-the-counter trading. They can also be transferred by relatives and friends for or without consideration. Normally, when we talk about stock exchanges, the very first thing that comes to our mind is the New York Stock Exchange, NYSE, which is the world's largest stock exchange, valued at USD 25.8 trillion as of June 2022. We may be wondering then, what is Wall Street? Wall Street is a term which describes the financial markets and companies trading publicly on exchanges throughout US and is headquartered to very famous US brokerages and investment banks. Let us turn our attention to Indian stock exchanges. Bombay Stock Exchange, BSE, is the oldest in Asia. If you really want to invest in shares in new companies, BSE is an ideal choice. National Stock Exchange, NSE, is the biggest stock exchange in India, and the volume of trade is much higher than BSE. So, if you are a day trader or a dealer in derivatives, futures and options, NSE is a preferred choice. One more thing, NSE software is way ahead of BSE when it comes to high risk online transactions. So my friends, NSE is normally the preferred choice, as we have mentioned. More about European stock exchanges like Euronext, Asian stock exchanges like Shanghai, in our tidbits coming out very soon. Wait for very interesting, short but extremely informative topics in tidbits which will be posted along with this particular series very soon. When you watch some of the TV channels or read the newspapers, you always hear and read the terms like Sensex, Nifty, and suddenly you realize that when the Sensex go up or the Nifty values go up, you think that the economy is doing well and therefore the country itself is doing well. Alright, what are these Sensex and Nifty? Both Sensex and Nifty are benchmark index values for measuring the overall performance of stock exchange. While Nifty represents a weighted average of 50 of the largest Indian companies listed in NSE, that is how the average of the performance is taken. In the case of Sensex, they take 30 of well-established and sound companies listed in BSE. We know by now that derivatives are used by traders to speculate on the future price movements of these assets without having to purchase the actual assets and hoping to book profits. They are booking profits in NSEs and also making sure that these plans that they work out to buy and sell without actually buying and selling through these stock exchanges give them enough amount of money. More about it when we start working actually. But one of the things you should know by now is option trading is regarded as one of the safest forms of investment when it comes to any of these assets. In summary, normally equity is traded through the stock exchanges. Even though over-the-counter transfers are all possible, 99% of the transactions take place through these stock exchanges. And that is why we have insisted on playing some games. This weekend you will be playing games on options and futures to further understand how these equities can be manipulated to gain more money in your investments. So don't skip the games, guys. I will see you tomorrow with another interesting topic.